Welcome back, ladies and gentlemen. Butcher Wall Street here. We have another AMC earnings beat. This is the 11th time in a row, 11th quarter in a row that AMC Theaters has exceeded their earnings. And of course, magically, the stock price went down, almost as if investors were selling off. However, we know that not to be the case because AMC Theaters recently confirmed that there are over 3.8 million American investors alone, not including people all around the rest of the world. Welcome, everybody. Zachary, Paul, KD, Lawrence, Pantheon, XLib, K Crusher. Thank you guys for being here. And also in the think tank right here on Discord. Thank you, ladies and gentlemen, for being with me. Gary, English, Felix, Init Kim, Elmo, Maximilian, Mancheska, Road Dog. Quite a few names here. Wolfie and friends that we've been hanging out with here for almost 3 years now. That is fucking awesome. That's how we know that people are diamond handing. AMC earnings call begins in about 6 minutes. We have it here. We have their cheesy jazz music here in the background, but we have it muted. Just because I don't really feel like listening to their jazz right now. What's up, Airplane Mode? Giles. Let's see, Keith. WOPR. Fatter than chocolate cake. Holding in Australia. Oh, why am I not surprised, man? Yeah, this is fantastic news, ladies and gentlemen. This earnings call starts in just over 5 minutes. I have it ready right here, so we won't miss a second. Taking a peek real quick at what the report actually says before we listen to the earnings call. Here we go. Tell me if this is a beat or not. I want to hear your guys down in the comments, down in the live chat stream, both of them. Put down, is this an earnings beat or is this a miss? Let's see. Total revenues grew 23% to $4.8 billion in the fourth quarter of 2023 compared to $3.9 billion in the fourth quarter of 2022. Ladies and gentlemen, a 23% increase in total revenues for AMC Theaters in spite of a writer's strike that lasted for months. Is that a beat or is that a miss? I'm not entirely sure. I've never read a financial report or an earnings report before. What do you guys think? Give me 1 second. Hey, baby, is everything all right? Yeah. Okay, Mom will be there to pick you up soon. Okay, cool. Everything okay? I'm in the middle of a stream right now.
Oh, never mind.
You good?
Yeah.
All right, then. Okay, I'll see you in a little while. All right, bye. Thank you, ladies and gentlemen. You know, family comes first. As much as I love my ape family, I also love my everyday family, as annoying as they can sometimes be. This was not one of those annoying phone calls. So, earnings beat or earnings miss. Total revenues for the fourth quarter of 2023 compared to 2022 are up 23%. Absolutely massive numbers. A lot of it can be attributed to retail investors, apes such as yourself, and a lot of it can be attributed to smart business moves by the one and only CEO, Adam Aron, and the board of directors. Now, tell me if this is a beat or a miss, ladies and gentlemen. Let me see how much time we have left. Don't worry, you're not going to miss anything. It starts in 3 minutes. So AMC had a net loss for the quarter, but it improved by over $500 million to only, granted still pretty significant, but only a $396 million loss, including a non-cash impairment charge related to long-lived assets of $106.9 million. So that was an impairment charge that they saw there for a net loss of $396 million for the quarter compared to a net loss in 2022 of $973 million, which included a similar but slightly higher non-cash impairment charge. Would you guys consider that getting much closer to quarter-over-quarter profitability by over $500 million in spite of a writer's strike, an earnings beat, or an earnings miss? Adjusted net loss was $318 million, an improvement of over $400 million compared to 2022. Now, for those of you that are unaware, a non-cash impairment charge, I'm getting this question, it's basically accounting for a reduction in the value of an asset due to a decrease in its expected future cash flows or fair value. So this could be seen as a $106.9 million impairment charge for the reduction of the value of Hycroft Mining Corporation's stock price, although we know that to be highly manipulated, much in the way that AMC stock is, because Hycroft Mining Corporation, in which AMC Theaters is a large shareholder in, along with Eric Sprott of PSLV, Sprott Physical Silver Trust, is going to begin mining gold and silver here in Q3 of this year, if not Q2. But I know for sure by Q3 due to their some of their most recent information. So they're going to be, and they also found at Hycroft Mining Corporation much greater concentration and higher quality gold and silver than they ever expected. So, in addition from that, so you could say that this $106 million loss is due to the reduction in value of their shares of Hycroft Mining Corporation, which once they start mining that gold and silver here next quarter, that will actually become a gain instead of a net loss, especially as more people buy gold and silver mining companies. We've got another earnings beat. Let's see, adjusted net loss was reduced in spite of the other issues with Hycroft, and their net loss per diluted shares was only $2.37 compared to $9.29 for 2022. This is a reduction of a net loss by over $5 a share, an improvement of $6.92 a share, actually. Still waiting on AMC. You can hear the beautiful jazz music in the background. We are not missing anything. Another earnings beat. Let's see, their adjusted net loss per diluted share was $1.90 for the Q4 of 23 compared to $6.95 for the same period in 2022, an improvement of over $5 a share. Adjusted EBITDA, earnings before interest, tax, depreciation, and adjustments, was $425 million, their adjusted EBITDA earnings. That's an increase of $379 million compared to 2022, quarter over quarter. Another earnings beat. Let's see, full year. Oh, this is the full year summary here. So, excuse me, it's not quarter over quarter. I glazed over the full year part. That's for year over year. Net cash used in operating activities was $215 million in net cash, which was an improvement, a savings of over $413 million compared to 2022. So AMC investors and diamond-handed apes are visiting AMC theaters in greater numbers, as are regular everyday folk who are not invested in the stock. And smart practices such as closing 100 underperforming movie theaters and opening 52 movie theaters that greatly exceed the revenues and profits of those 100 that were closed has allowed AMC theaters to increase and improve their net cash used in operating activities by over $413 million. That means that they saved $413 million compared to 2022 simply in operating costs. This is huge. And the non-GAAP operating cash generated, the money spent, was only $68 million, which is an improvement of over $361.9 million compared to the year prior.
Thank you, Diego. Good afternoon.
Earnings has
I'd like to
begun.
welcome everyone to AMC's
Let me adjust my sound for you guys. I'll turn up AMC.
Webcast. With me this afternoon is Adam Aaron, our Chairman and CEO, and Sean Goodman, our Chief Financial Officer. Before I turn the webcast over to Adam, let me remind everyone that some of the comments made by management during this webcast may contain forward-looking statements that are based on management's current expectations. Numerous risks, uncertainties, and other factors may cause actual results to differ materially from those that might be expressed today. Many of these risks and uncertainties are discussed in our most recent public filings, including our most recently filed 10-K and 10-Q. Several of the factors that will determine the company's future results are beyond the ability of the company to control or predict. In light of the uncertainties inherent in any forward-looking statements, listeners are cautioned against relying on these statements. The company undertakes no obligation to revise or update any forward-looking statements, whether as a result of new information or future events. On this webcast, we may reference non-GAAP financial measures such as adjusted EBITDA, constant currency, free cash flow, non-GAAP operating cash burn, and operating cash generated, among others. For a full reconciliation of our non-GAAP measures to GAAP results, please see our earnings release posted in the Investor Relations section of our website earlier this afternoon. After our prepared remarks, there will be a question and answer session. This afternoon's webcast is being recorded, and a replay will be available in the Investor Relations section of our website at amctheaters.com later today. With that, I'll turn the call over to Adam.
Thank you, John. Good afternoon, and thank you, everyone, for joining us today.
Let's go, Adam.
2023 marked another year of strong operational and financial gains for AMC Entertainment, affirming the success of our strategic recovery efforts as the industry continues to rebound from the lingering effects of the pandemic. Our determination, innovation, and agility allowed us to adapt to a rapidly changing and unpredictable box office in calendar year 2023. And once again, it allowed AMC to defy Wall Street's expectations, beating FactSet and Refinitiv consensus estimates in Q4 and for full year 2023 for revenue, adjusted EBITDA, adjusted net income, and adjusted earnings per share. As a result of our actions, global attendance at AMC Theaters in 2023 tallied nearly 240 million guests, up 19% over the prior year, and marking the highest annual attendance in the post-pandemic era for AMC. When you couple our 2023 attendance growth with our all-time record-setting admissions revenue and our all-time record-setting food and beverage revenues per patron, AMC's annual revenues grew by 23%, exceeding $4.8 billion in 2023, and our adjusted EBITDA improved by $379 million to $426 million in 2023. It was the highest level for adjusted EBITDA in 4 years, the highest revenues for AMC in 4 years, and in fact, our adjusted EBITDA was up more than 9 times what it was just a year earlier in calendar year 2022. Unquestionably, our positive recovery trajectory continued in 2023. Not enough for where we hope to eventually wind up in the year ahead or the years ahead, but encouraging progress again was made. We're also proud that when you look at the magnitude of our revenue and adjusted EBITDA increases, AMC is outshining several of our largest and most important key competitors in the U.S. and in Europe. One of AMC's most essential accomplishments, which may not be widely understood, is just how efficient we have become after having to adapt to pandemic stresses these past 4 years. Thanks to AMC's increased high-margin food, beverage, and merchandise sales, rising ticket prices, our industry-leading premium large format capacity, a commitment to laser projection, pruning our network of some marginal theaters and replacing them with some clear winners, and of course, holding the line on costs, AMC's internal analysis reveals to us that our contribution per patron is up by some 37% versus what it was before the pandemic. This means that AMC does not need for the industry box office to return completely to pre-pandemic levels for AMC's adjusted EBITDA to dramatically outstrip what we generated historically. Speaking of the box office, let's turn to the domestic industry box office as a placeholder for the size of our industry and to demonstrate our industry's long climb back from COVID. We all know that the box office fell from $11.4 billion in 2019 to $2.2 billion in the height of the pandemic, calendar year 2020. But then the domestic industry box office started on its rebound, up to $4.5 billion in 2021, to $7.5 billion in 2022, and it grew again in 2023 by 21% to more than $9 billion in the year just completed. That is an upward slope for sure. Again, it's not enough, but again, progress has been made. And in looking at the fourth quarter of 2023 in particular, what is particularly noteworthy about the box office is how our company, AMC Entertainment, reshaped the box office and how much AMC benefited from our trailblazing, industry-leading efforts with our highly successful distribution of two concert movies, Taylor Swift: The Eras Tour, and Renaissance, a film by Beyoncé. In the fourth quarter, compared to the same quarter a year ago, AMC's revenue grew by 11.5%, and AMC's adjusted EBITDA almost tripled. Literally, all of that increase in AMC's revenue and all of that increase in AMC's adjusted EBITDA is attributable to our having shown these two concert movies in our theaters in the U.S. and internationally. They also caused AMC's U.S. market share to noticeably rise. That's because our share on these two concert films, the two that we not only exhibited but also were the distributor for, were well more than 50% higher than our market share normally. If that's not enough, both of these two movies played to rave critical acclaim. Each received a rare A+ cinema score, and the Rotten Tomatoes response was astronomical, with Taylor's film scoring a 99.98 and Beyoncé's film scoring a 97.99. With some $213 million in domestic ticket sales within Q4, these two movies added greatly, not only to AMC's bottom line, but to movie theater success across our entire industry, as just these two films represented fully 1/9 of the complete fourth quarter domestic industry-wide box office, 1/9 from our two movies. Taylor's movie in particular was the single highest grossing movie of them all within the fourth quarter at the domestic box office. And worldwide, at $275 million of gross, Taylor's film also was the highest grossing concert film of all time and the highest grossing documentary of all time. It's hard to believe, but it's true. Only Universal and Warner significantly outgrossed AMC Theaters distribution domestically in the fourth quarter of 2023. With just these two movies, AMC Theaters distribution had a domestic box office gross during the months of October, November, and December of 23 that was only 1.6% less than that of industry behemoth Disney. And our two films domestically outgrossed all of what was offered theatrically in the quarter by Paramount, by Sony, by Lionsgate, or by any of the other smaller movie makers. This is a stunning result, given that neither of these films were on anyone's drawing board until mid-year, and that they were the first movies ever distributed by AMC in our entire 103-year history. What a triumph for our company. To that end, it is no surprise then that our praise for Taylor Swift and for Beyonce Knowles Carter has no limit. And you will surely understand why we offer our boundless thanks to these two world-class artists for entrusting AMC to collaborate with them as to the theatrical exhibition of their two masterpiece creations. I should add that I've said before that our phones have been ringing off the hook, and I can confirm to you today that we are now in constant touch with others who are seeking that AMC also distribute the movies of more world-class musical artists for later in 2024 and or 2025. This blending of great musicians and movie theaters is an innovation for AMC that should and will continue into the future. But make no mistake about it, as pleased as we are with the movies that we distributed, or as pleased as we are with our entire results for the entire year of 2023, 2023 did not live up to its full potential. That's because the many months of actors and writers' strikes crippled Hollywood, and they seriously hurt movie theater operators who have been forced to wait for delayed movie titles that shifted out of 2023 into future time periods. After 3 years of hard work by one and all, after theaters were closed back in 2020, the domestic industry-wide box office finally was in sight of pre-pandemic levels back in the summer of 2023. At the peak of the summer of 23, the July 23 domestic box office was actually up 6% above July of 2019, the last July pre-pandemic. And in that summer quarter of 2023, AMC generated the highest third quarter adjusted EBITDA ever. Clearly, moviegoers flock to theaters when Hollywood releases films in quantity and in quality. Just think, Barbie and Oppenheimer. Or for that matter, think of what came out of Leawood, Kansas, Taylor Swift, the Eras Tour, among others. But the strike of 23 clearly interrupted that momentum that was pushing us to above pandemic norms in the middle of last year. The strikes in Hollywood led to the fourth quarter domestic industry-wide box office being down 35% versus pre-pandemic 2019. The January-February 2024 domestic industry-wide box office was down about 45% versus the same months of pre-pandemic 2020. We point this out not to alarm you or to whine about it, but instead because we want everyone to realize that by the middle of 23, we had finally emerged from the cloud of the pandemic. But then the strike hit and sent us back into the soup. However, at AMC, we believe that the strike impacts will only be short-term in nature. AMC believes that the box office will start to strengthen again as soon as this coming month of March, in some of the summer months of 2024, and especially in the latter third of this year. And over the medium term, we are both bullish and optimistic. With all the caveats that no one's crystal ball is perfect, at AMC, we currently believe that the industry box office in 2025 will be robust. We believe it will grow by $1 billion to $2 billion or more in size over what will be the box office in 2024. With that as an introduction to our results for the quarter and the year, I'll now pass the webcast over to Sean, our Chief Financial Officer, to provide more details on our quarterly and full-year financial results and especially to share with you the progress that AMC has made in reducing our debt and in bolstering our cash reserves.
Even with the writer's
After
strike.
that, I'll return to provide you with my further take on where we are at the moment as a company and share some other news that may be of interest. Sean?
AMC smashed
Thanks,
earnings
Adam.
in spite of an earnings.
Thank you to everyone for joining us
In
this
spite of a
afternoon.
writer's strike.
I'd like to start my prepared remarks by briefly looking back over the last 4 years. No doubt our business has experienced challenges like never before.
Don't fall asleep with this guy. I know sometimes he's a little bit long-winded, but this guy's good. He's not a showman. He's a man of facts. So you have to listen carefully. And then at the end of this, Adam Aaron just announced he's going to give us some very interesting news. And I'm looking forward to hearing that.
Office recovers towards pre-pandemic levels. Over the last 4 years, we've improved our per patron revenue and per patron profit quite considerably. In 2023, our consolidated per patron revenue was around 32% higher than in pre-pandemic 2019. This was driven primarily by growth in food and beverage spend per patron of 45.7%. And we've also increased our contribution dollars per patron. Contribution dollars here defined as total revenue less both film exhibition costs and food and beverage costs. And we lessened this by approximately 37%. So we've increased these contribution dollars per patron by approximately 37%. At the same time, we've worked hard to enhance our theatre portfolio. We've been closing underperforming theatres and opportunistically opening higher-performing theatre locations. As an illustration of the impact of the changes that we have made in our business, consider for a moment the following. In 2023, our domestic attendance was 32.3% less than in 2019. At the same time, we were able to keep revenue per screen flat in 2019 and increase our contribution dollars per screen by approximately 4.3%. So with 32% lower attendance, our contribution dollars per screen actually increased by 4.3%.
That's amazing.
The consolidated statistics I've quoted are in constant currency and help explain why we believe that A, the box office does not need to get all the way back to pre-pandemic levels for us to achieve pre-pandemic adjusted EBITDA. And B, at pre-pandemic box office levels, we should be able to achieve higher adjusted EBITDA than we were able to before the pandemic. And finally, looking back over the last 4 years, we have very actively worked to strengthen our balance sheet by reducing debt and increasing liquidity. It's worth noting that the total principal amount of our corporate borrowings and finance leases at December 31, 2023 was $4.56 billion. This is approximately $451 million lower than 4 years ago at December 31, 2019. And our net debt at December 31, 2023, net debt defined as total corporate borrowings and finance leases less available cash. This number was nearly $1.1 billion lower than 4 years ago at December 31, 2019, prior to the devastating impact of COVID on our industry. At the same time, it's also worth noting that given pressure from a rising interest rate environment and our heightened leverage ratios due to the box office being still well below pre-pandemic levels, our interest expense during 2023 was approximately $70 million higher than in 2019. Now to the results for 2023. AMC generated more than $4.8 billion in consolidated revenue for the year, marking a solid 23% increase compared to 2022. Likewise, adjusted EBITDA increased more than ninefold compared to 2022 to $426 million. And for the first time since 2019, we achieved positive adjusted EBITDA in all 4 quarters of the year. Now, looking specifically at the fourth quarter of 2023 compared to last year, The North American box office grew by nearly 5%, with Taylor Swift's The Eras Tour, distributed by AMC, leading the way. With market share gains, in part from the success of The Eras Tour, and very strong food and beverage per patron growth, our fourth quarter consolidated revenue increased by 11.5% to $1.1 billion. Domestic revenue in Q4 increased by 12.9% as a result of record-setting admissions revenue per patron of $12.83. This is 5% higher than a year ago, and record food and beverage revenue per patron of $8.31. This is an increase of 7.1% compared to 2022. It should also be noted that other revenue grew in total by approximately 32%, this driven by distribution fees associated with the concert movies, together with increases in retail popcorn sales and sales of movie-themed and AMC-branded merchandise. In our international business, competitive dynamics limited our ability to take price increases without adversely impacting market share. Attendance in the quarter increased by 3.9%, and on a constant currency basis, revenue increased by 2.5%, with admissions revenue per patron decreasing by 1.4% to $9.27, and food and beverage revenue per patron growing slightly. Cash equivalents of $884.3 million. For the full year, non-GAAP operating cash generated, which is a measure representing cash flow from operations after deducting capital expenditures and before both debt servicing costs and deferred rent payback. This was a positive $68.3 million, a $362 million improvement compared to last year. For the fourth quarter, non-GAAP operating cash burn was less than $1 million. CapEx net of landlord contributions was $64.2 million in the fourth quarter, bringing the year-to-date net CapEx spend to $201.7 million, right at the midpoint of our 2023 net CapEx guidance. We expect that CapEx in 2024 to be in the range of $175 to $225 million. From a theater perspective, we continue to actively manage our footprint, and during the fourth quarter, we added 2 new high-performing theaters and closed 9 underperforming locations. This brings the total number of locations closed since the pandemic began to 165, and the total new locations opened to 59, for a net reduction of 106 locations, or 10.6% of the locations at December 31st, 2019. Going forward, as we continue to rationalize the theater portfolio, we will also continue to invest in our circus to enhance the guest experience. To ensure our ongoing recovery and ability to thrive as our industry grows, our top 2 capital allocation priorities must remain the same. 1, we must ensure that we have sufficient liquidity to manage through this recovery phase, including the impact of last year's Hollywood strikes. And 2, we must strengthen our balance sheet by extending debt maturities and improving our financial leverage, thereby reducing our debt servicing costs. During the fourth quarter, we successfully raised $350 million of gross equity capital. We then repurchased $50 million of debt at an average discount of 20%. We exchanged $105 million of debt for roughly 14.2 million shares of common stock, and we repaid $17.9 million of deferred rent. The deferred rent balance at the end of 2023 was $56.3 million, and we plan to reduce this balance by another approximately $20 million by the end of 2024. Overall, since the beginning of 2023, we have raised $865 million of gross equity capital. We've lowered the principal value of our debt and finance leases by $466 million. We did this through debt repurchases or exchanges of debt for equity, and we have repaid $101 million of deferred rent. This all for a total reduction of debt and deferred rent of $567 million. The debt reduction since the beginning of 2023 has lowered our future annual cash interest expense by approximately $44 million. All told, as of today, we have reduced our debt and deferred rent liabilities by approximately $958 million since the beginning of 2022, so over the last 2 years. Having the flexibility to raise equity capital has been critical to our survival, and it has allowed us to seize opportunities to strengthen our balance sheet and build a foundation from which to thrive as the film exhibition industry recovers. Capital markets actions that we took during 2023 have positioned us to face with confidence the probability of a relatively weak near-term box office, especially during the first half of 2024. While the box office for the first half of the year will likely underperform last year, we are increasingly optimistic about the outlook for the latter half of 2024, and the film slate for 2025 looks incredibly exciting. And now I'll hand the webcast back over to Adam.
Thank you, Sean. As I said earlier, and as our financial results prove, 2023 was clearly another year of recovery and improved performance for AMC. But it was not a good year for our shareholders. Adjusted for stock splits, the AMC share price has fallen to a fraction of where it was as recently as last summer. And I promised our shareholders that I would use this earnings webcast as a forum to provide them with some straight talk.
Here you go.
To
You
give
want it?
them
Listen.
my take. So here's my take. There is so much garbage information floating around Twitter, YouTube, and other corners of the internet about AMC. Conspiracy theories abound, facts are distorted, bad motives are assumed when the exact opposite is true. So I want to address some of these issues so you get the straight scoop. I can't address all of those issues in the limited amount of time that we have, but I do want to address some of the most important. First, as to all the hubbub and litigation that surrounded AMC in the Delaware courts in 2023, I want to remind you that our shareholders got the right to vote on our proposed actions.
And we voted yes.
And not only did the preferred shareholders vote in favor of what we did last year, but also of the common shareholders who voted, their count also was in the affirmative by a wide 72 to 28 margin. Then the Delaware courts ruled that the company could settle the litigation surrounding those shareholder votes and proceed to implement exactly as our shareholders voted. Second, as to dilution, back in the summer of 2021, it's a long time ago, after it was clear that shareholder sentiment was not wholly supportive of more equity sales, we said there would be no more in 2021, and we kept our word. Some critics, assigning us bad motives, were convinced that we would start more equity sales in the very first week of 2022, since the commitment we made only incorporated 2021. But they were wrong. We sat on the sidelines for almost 8 months in 2022. But by August of 2022, we did in fact introduce into the market AMC preferred equity units because, among other reasons, we wish to make it possible for AMC to raise more cash through the sale of shares if we thought it was advisable or if we needed to do so.
And it saved our
We were
ass.
very clear about this in our public disclosures at the time. Between August of 2022 and June 30 of 2023, AMC raised $418 million by selling what were called apes. AMC's cash position at that end of June 2023 was $435 million. $418 million raised, $435 million of cash. Do the math. Had we not sold those shares, deduct $418 million from $435 million. Big companies, the size and scope of AMC Entertainment, cannot survive with only $17 million of cash on hand.
He saved your ass
Similarly,
and my ass,
In
period.
the full year of calendar year 2023, AMC raised $865 million of cash through the sale of apes and the sale of common stock. We ended the year with $884 million of cash. $865 million raised, $884 million of year-ending cash. Again, do the math.
Bravo.
Had we not sold that equity, deduct $865 million from $884 million. Big companies, the size and scope of AMC, cannot survive with only $19 million of cash on hand. We did, in dilution, what was absolutely vital for your company to do to get through the many challenges that have been thrown our way. The absolute smartest way for AMC first to survive and then eventually to be in a position to thrive is to have robust cash reserves. Period. Plain and simple. There can be no argument. Cash is king. Third, from time to time, there have been matters related to the trading of AMC stock that have been of concern to some of our shareholders. As but 3 examples, the absolute number of failed to deliver shares, synthetic shares, or the length of time AMC Entertainment was on the threshold list, among others. We dutifully have kept the New York Stock Exchange and appropriate regulatory bodies well informed, and we make frequent public filings. But here is a key reminder and clarification. AMC is a company that is listed on the New York Stock Exchange, but we are not the stock exchange itself.
Bingo.
Frankly, we have no ability to regulate or enforce trading practices on the stock exchange. And as much as some of you may wish it to be otherwise, our business is the exhibiting of movies in theaters. We are not in the business of reforming the financial markets overall.
He is
Then,
correct.
as to our motives, it's disappointing how many people out there type into their Twitter feeds that the management team at AMC is somehow actively working against the interests of our retail shareholders and instead is nefariously on the side of evil, the so-called hedgies. A company that does not post the kind of improving financial results as AMC just did today, if one is out to sabotage one's owners. One does not sell $54 million of movie-themed merchandise in our theaters and online, as AMC did in 2023, versus virtually no sales of such items only a few years ago, if their motives are impure. And I should point out, by the way, that selling merchandise was an idea that came in from our retail shareholders, by the way. Similarly, one doesn't launch popcorn to the home or blaze new trails with innovative concert movies that have been incredibly profitable and reputationally enhancing for AMC if one is trying to undermine our company's success. So given all that, then why has our share price been falling? Are those conspiracy theories right? There are many, many complicated factors that affect any share price. Some well understood, some not so well understood. But my own view is pretty basic and overarching. It is this. It has taken way too long for the entire movie theater industry, including AMC, to recover in attendance or to recover financially from the impact of COVID. Also bad, just as adjusted EBITDA in the summer of 2023 was returning to more acceptable pre-COVID levels, no one needed for the movie industry to be paralyzed by debilitating strikes, which will temporarily challenge AMC earnings in 2024. We believe there are numerous other reasons too, like rising interest rates and inflationary wage and cost pressures, among many others. But in my mind, the key issues are, first, the long, drawn-out recovery, and then the strikes of 2023, combined with the steps we've been forced to take to wade through 4+ years of a depressed box office. These are the issues that have pressured AMC share price. So let's cut to the chase. Looking ahead, is there hope? As I stated earlier, the box office should start to strengthen beginning as soon as March, a month that starts a mere 2 days from now.
Shorts are fucked.
It should further pick up later in 2024. And the box office for 2025 could be very favorable, as movies that might have been released sooner finally get released in 2025. So yes, in my view, there's good reason to be optimistic. That optimism notwithstanding, AMC must continue to address our debt load, extend our debt maturities, currently mostly in 2026, and push them out into later years, and also to ensure that our cash reserves remain robust. That is the recipe for success. Remember what I said earlier on this call. Cash is king. At AMC, our strategy is sound. Run the best company we can. Please our guests at theaters and serve them well. Prudently innovate. Drive the most earnings we can. Reduce debt, extend debt maturities, and have the cash reserves on hand to outlast the tough times. Doing all that, which is what AMC has been doing so well over these past several years, is what makes me optimistic and confident about the future. Because as the clear leader of the movie theater industry and the clear leader by a wide margin, AMC is doing all the right things. There's one more topic that I want to raise before we turn to your questions. And that is our interests, meaning the interests of our shareholders and my interests as CEO of the company and as a shareholder myself are perfectly aligned. I personally am AMC's largest retail shareholder.
Number one, silverback.
As your shares rise in value, so do mine rise. As your shares fall in value, so do mine fall. In the last 6 months, as the AMC share price has dropped, I personally have lost tens of millions of dollars in the value of my AMC shareholdings and in my granted but unvested stock. I assure you that focuses the mind. In my stock losses, I share in your frustration, I feel your pain, and I'm heavily incentivized to get the value of your AMC shares back on the right track. In the past 2+ years, I have been a holder of AMC stock, not a seller. Indeed, I have not sold a single AMC share since January of 2022. While I have forfeited granted shares on the same day as they vest to pay the federal and state income tax withholdings that are immediately due upon that vesting, I have not sold even one share in the marketplace, not one share in the last 25 months. I wrote often on Twitter that I ride with you. I am a shareholder. I am holding. I'm not selling. I ride with you.
I'm not fucking
So
leaving.
when you do well financially with AMC, I will too. But if you're hurting from that investment, I believe that I too should be hurting with you as well. Therefore, To prove that these words are not hollow and to show executive leadership from someone who is in your foxhole, I want you to know that I recommended last week to the AMC Board of Directors that for the next 12 months, starting right now, my target compensation should be substantially reduced. While my actual compensation can be at the target, below the target, or above the target based on the company's financial results, the board and I agreed that my target compensation will go down right now as we move forward by 25% versus the previous year's target. And maybe even more of relevance, if you compare my new lowered target compensation against my actual compensation for the past year, as most recently publicly reported, that's actually a 50% reduction in my potential compensation in the year ahead.
Attention shills, Adam Aaron cut his pay in half, and he has not
There's
sold
no
a
anguish
fucking
in my
share
voice
since
about
2021.
That is what a CEO of a company like yours should do, because I mean it when I say that I ride with you.
Damn right.
You now know
I stand
what
with
I
Adam
think.
Aaron.
2023 was a year of superb achievement and innovation at AMC. Unfortunately, AMC starts out 24 with $884 million of cash. Cash is king. I've said it multiple times, and that is the guiding philosophy that has caused this company to stay in a leadership posture no matter what the world threw at us starting at 2020 and since. While the box office took a 5-month downturn starting in October of 2023 because of the long strikes in Hollywood, things will pick up considerably soon, and then again later in 2024. And 2025, which in the grand scheme of things is right around the corner, could be a gangbusters year, both for our industry and for AMC as a company. We are in this together, you and I, and here's hoping that we all are smiling as we head in the next year. With that, Sean, let's move to questions from analysts and from our shareholders.
Thank you.
Again, maybe you guys didn't realize this, but Adam Aaron said Q&A is about to start. You're not missing anything right now. Briefly, I'm going to say Adam Aaron has clearly said there are issues that make it easy for companies to naked short AMC because they are a movie theater company. They are not the DTCC. They cannot create stock market reform. Plain and simple. You want stock market reform? Let's reform it ourselves. Look out for a company called Lit Exchange, in which you can send orders directly to lit markets and avoid price distorting and price suppressing dark pools, where your dollars actually make a difference on the national best bid and offer. You will not be disappointed. Make your own fucking change. AMC Theaters puts out good movies, good popcorn, good food, good distributed movies, and all sorts of other things. But they are not the DTCC. They are not a stock brokerage firm. They cannot process orders and trades directly on lit markets. Lit Exchange can do that. Let's go back to the call.
I guess as you continue to build